Hello traders, welcome back to the channel. Today I am going to break down market structure and explain how you can position yourself in the correct market direction so you won't end up on the wrong side of the market. So let's get straight into it. So what is market structure? Market structure refers to how price transitions between phases through displacement, liquidity runs, and market structure shifts. It focuses on how smart money moves price by first attacking liquidity and then creating strong displacement, which signals a shift in the market's direction and the start of a new delivery phase. But the common issue here is most traders try to trade right after a liquidity sweep, but the market stops them out and doesn't reverse. These traders keep thinking that maybe there was more liquidity to the upside and that the market will reverse from there. Everyone says you need to be accountable in trading, so these traders assume it was their own mistake for choosing the wrong liquidity level, but in reality, it isn't. The truth is, there is no mistake. It's simply a lack of understanding of market structure. If you had a clear understanding of market structure, you would have caught the long opportunity shown in this example. You wouldn't even consider taking short trades after this buy-side liquidity sweep. So what is the solution? Don't worry, I will give you the easiest method to understand market structure. First, I will give you a simple three-step framework to understand market structure so you can position yourself in the correct direction of the market. We will use only three things: 15-minute liquidity levels, market structure shift, and fair value gap. I will also explain when to expect reversals from a liquidity level and when you shouldn't. By the end, you will know how to understand market structure so you can place yourself on the right side of the market with the help of liquidity sweeps and fair value gaps. Let's get into the charts, and I will first explain the three-step process. Then we will look at some examples. First, let me explain the three-step process that you must follow before taking any trade. Let me draw a diagram for you to explain it in a simple way. Now, look at this. This is a buy-side liquidity sweep, right? Now you will try to short from this sweep because you can see sell-side liquidity resting below. You might think you can target that sell-side liquidity, but the reality is different. I am not saying you are doing anything wrong. Everyone thinks this way because we all know that reversals usually happen at liquidity levels. But there is another important factor that tells us whether the probability favors a reversal or a continuation, and that is market structure. If you can understand market structure, you will know when to expect a reversal and when not. The first step is to check whether there is any market structure shift on the left side before the liquidity dip sweep. As you can see, we do have a market structure shift. That simply means the market has created a shift to the upside, and it can retrace and then continue in the upward direction. Step 2 is to look for any fair value gap resting within this range. You may wonder, which range? How do I know? You have to look within the range that forms after the market structure shift. For example, we have a market structure shift in this range, so you should look for a fair value gap inside this range. Now, suppose we have a fair value gap in this range, something like this, so we have to mark it out. Step 3 is to identify any lower time frame, low or high, depending on your direction. Let me write all of this so you can take a screenshot and watch it anytime you want. Why do you need this? Because that becomes your liquidity level. Then, suppose you have any low like this on your lower time frame, then you have to mark the low. Then the market will typically do something like this on your lower time frame. It will sweep your liquidity and then continue in the direction supported by the market structure shift. But follow this process only if you have a market structure shift on the 15-minute time frame before the sweep of your key liquidity level. If there is no market structure shift on the 15-minute time frame before the sweep, only then you can expect a reversal. Let me describe it with a raw diagram so you can understand it clearly. Now suppose this is a buy-side liquidity sweep. Tell me, is there any market structure shift before the liquidity sweep? No. So think about it. If we don't have any market structure shift before the liquidity sweep, what does it mean? It simply means that there is not any bullish market structure shift or bullish signatures in price, which can tell us that the market could move higher. So this type of market structure is suitable for expecting a reversal. You should only expect a reversal when you have this kind of market structure. Now the third and most important step is to check whether there is any internal range liquidity sweep before your key liquidity level gets taken out. In simple words, you must look for a liquidity sweep that occurs before the liquidity level from which you are expecting your trade. Let me draw a diagram to explain this. Now look at this. Suppose this is a buy-side liquidity level where you are looking to short, and this is a sell-side liquidity sweep that was taken before your buy-side sweep. Now, is this a liquidity sweep? Yes. Is this a market structure shift? Yes. Is this a fair value gap? Yes. If you spot any market structure like this, then you should never try to trade these types of setups. But why? Think about this. If this FVG is being respected, which means market didn't invalidate this fair value gap and went higher after retracing back to it. And if this liquidity sweep is valid because price reached the opposing liquidity level, then why are you trying to short a market where the structure is clearly telling you it wants to go higher? If the market structure looks like this, it will most likely continue higher and will not retrace until a major liquidity level gets taken out. And if you try to chase these kinds of moves, the market can reverse from any random level that you won't even be aware of. Don't try to do the opposite. Instead, read the market structure and get yourself in sync with it. Now let's look at the charts. Here you can see a buy-side liquidity sweep, and now you want to look for short opportunities. Remember my three-step process. Is this a sell-side liquidity sweep? Yes. Okay, then let's try to short the market once again if it sweeps the buy-side liquidity. But what happened? Exactly the same thing I taught you in the diagram. This becomes a market structure shift. The market taps into the fair value gap and then expands higher. Look at what happened here. Let me explain the exact reason behind this. Here, the market swept the sell-side liquidity, then respected an order block, created a market structure shift, and formed a fair value gap. If you think this is incorrect, then mark this high and the next high and try to take shorts. But the market does not reverse, even though these two lows are resting below and you want to target them. Think about it. If the market structure is telling you that it wants to expand higher and it is respecting all the bullish levels, then why are you trying to do the opposite? Understand the structure and get in sync with it instead of taking trades based only on liquidity patterns. Now let's go to the charts and apply this to see what happens. Now look at this example. We have a sell-side liquidity sweep, and as usual, you might start looking for long opportunities. But we must focus on what I taught you in the three-step process. Notice this, the market has respected a fair value gap. Yes, we do have a buy-side liquidity sweep, and we also have a market structure shift. We don't have a fair value gap here, but we do have an order block. So what do you think will happen if I enter a short at this order block, place my stop above it, and target the next liquidity pool? Look at this. We hit our target. When the market structure is clearly showing that it wants to go lower, try to understand that instead of trading liquidity as if it were just a pattern. Now let's look at what happens next. Next, the market went straight to the buy-side liquidity. Now we have a buy-side liquidity sweep. Notice here that we don't have any market structure shift in this range. As I told you earlier, this is the scenario where we can expect a reversal. Now let's drop down to the 5-minute time frame. Here we finally have a market structure shift, so we will enter short, place the stop above the high, and target the sell-side liquidity. Now you can see that what I taught you earlier is working perfectly. You should now understand when to expect a reversal and when not. Moving forward, the sell side liquidity has been swept, so let's see what happens next. Now let's try to understand the market structure. Notice that we don't have any bullish market structure shift in this range. Instead, we now have a market structure shift to the downside. Additionally, the market has respected a fair value gap, and we also have a buy-side liquidity sweep. So let's enter short, place our stop above the high, and target the sell-side liquidity. We got a quick target. Next, we have a sell-side liquidity sweep and a bullish market structure shift. But remember, we already had a buy-side sweep and a market structure shift, which we used in the previous example. We also have a fair value gap, so we will enter short again, place our stop above the gap, and target the sell-side liquidity. Once again, we got our target. Now the sell side is swept, and you might be thinking about taking long trades. But notice here, we have a market structure shift and a fair value gap to the downside. So what do you think will happen if I enter short at this gap, place my stop above the high, and target the next liquidity pool? The market moved sideways for a while but still gave us our target. So now you should understand that trading based on liquidity alone is not enough. You must also read the market structure. The market moves the way it wants to move, and the only way to identify where it wants to go is by understanding market structure. If you learn to read market structure properly, you will no longer be confused by liquidity sweeps and reversals. Thank you for watching. If you'd like to continue learning with me, feel free to join my Telegram and Discord communities. And if you're interested in live trading, market overviews, or more in-depth guidance directly from me, just send me a message on Discord. We'll take it forward from there.